Okay, good morning, everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. Great to be back, guys. Today's Wednesday, February 14th. Happy Valentine's Day. We are just getting the print for CPI coming in stronger than expected, guys. 2.1% year on year. We're looking for 1.9. That matches the 2.1% clip that we got last month. Looking for the core read here in just a moment, guys, to see how that panned out. 1.8 versus 1.7. So strong across the board, okay? There's a lot of contention across the board as we head into this release today, just on the basis of the strong wage inflation numbers that we got with the NFP numbers. You saw a lot of expectations the Fed may need to, in fact, hasten their pace of asset or normalization rather as the market continues to improve. You're seeing the dollar with a market bounce here, guys. We talked about this yesterday. We'll go over it. We had a slope support here. We were looking, it broke below, but failed at former channel resistance. And here's the rebound higher. So look for 90. 11 is going to be the first initial areas of resistance that we're looking for on this. But before we get too ahead of ourselves, don't want to get too excited, okay? Keep in mind that the focus has been on the inflation numbers, and as it stands right now, market participants are still factoring in 2 to 3 hikes this year, okay? The question at hand is, do we get 4? With the inflationary picture continuing to outperform, that becomes more likely. You're seeing interest rate expectations start to move up. For the March read, while we're here, we might as well look it up. Okay, for the March read of interest rate expectations, if we just look at it with the CME is pricing in, you're looking at about 77%. Okay, that market's already factored in that we will see newly minted Fed governor or Fed chairman rather, Jerome Powell raise rates at his first interest rate decision at the quarterly meeting this March. So, that hasn't really been shifted too much. It was as high as 90% on the back of the last interest rate read. So this will continue to fluctuate, but the focus remains on dollar price action. Here's what the DXY looks like on the weekly basis. We've been following the analog from 1994. You guys have all seen this before. Jamie's been all over this. It's been so accurate. And if we just remove this temporarily right here, just to show you where we are, at this point, the analog does call for a hold below 91.33, still my base case scenario for that last drop. Again, if we go back to what that analog shows, basically we're in continuation. We should be looking for a move lower if this is going to hold. Near-term bearish invalidation remains at 91.33. So keep that in mind, even if we do get this strip getting a little bit higher on the swing. So interesting price action to say the least. Key support for the dollar index remains this 88.26, 88.71 level on this weekly chart. You have slope. You have the 2010 swing highs, and you have a basic 50% retrace from the advance off the 2011 lows. That all converges down here. So you have a very clear-cut key range to play with on the index. And again, this data offering some support. Here's what it looks like on the daily. Even on the daily chart, just within the confines of the slopes that we've been following off last year's high. Here's last year's open. Same slope. There's the channel. Break, saw acceleration, a little messy on the top side break, but break, saw acceleration, and here's where we capped off this month's opening range high so far. Monthly open comes in just a little bit lower at 89, at the 89 figure, and that's really what we'd need to break through to get this thing going towards that 88.27 key support. But base case scenario, as the analog suggests, you look for a new low, basically heading towards the end of this week, start of next week. Now, if we break through these highs, okay, 91.33 is going to be the broader bearish invalidation level. That's last week's low week reversal close, okay? And it coincides right on with the 50 line. So as far as key thresholds for the index are concerned, things are still pretty super clear to start off the month. We have a very clean monthly opening range just below slope resistance. You have key support on the downside. Look for a break of that range near term. Here's what it looks like on the intraday charts.
Your deal is confirmed.
So we had a little bit of a adjustment to our slope that we've been following. Here's what the update looked like earlier in the week. And certainly we talked about the index analog looking for another move lower this week. Here's where we start off the week. We pulled right off this, and how here we are reversing, trying to break back above. Again, 91.33 being the critical threshold. Here's what the intraday chart looked like earlier in the week. Okay, we were extending off that low, that stretch low that we made back earlier last month. On the break here, 89.75 is what I was looking for. So once we actually made that move, here's what it looked like last night. A slight adjustment to the slope kept us inside that, but still putting the emphasis on 89.50 support. So you can see that we went right through that, rebounded right off of former channel resistance, now support, and here we are breaking through. So 91.11 is your first level of resistance. We just tagged that right now. Big resistance as far as the near-term picture starts to move higher, okay, towards that 90.50 level, that 1618 extension that caught the highs last week. But if you're not already holding long dollar exposure, I'd be a little bit cautious of trying to chase this too much from this threshold, from this level. Okay, questions on the index before we move off. It's going to be a big week, guys. We do also have retail sales that came out as well, so markets are reacting to that. But as far as this stands, look for 91.11, 90.50 for exhaustion on this near-term rally in the DXY. Again, core and year-on-year reads topping expectations. That's the exact concern that you've been seeing in markets. Now, if we take a quick look at what the SPX is doing on the back of this release, obviously not surprising, you're seeing some weakness. Okay, here's the 120-minute chart on the S&P 500. Now, that weakness, again, you want to take with a grain of salt for now because, you know, let's take a step back. First of all, the weakness that we're seeing here is based on the fact that if, in fact, the Fed is going to have to hike interest rates faster than expected, it's going to sap some liquidity from broader risk assets, okay? And one thing that we've been watching is obviously the yield on the 10-year. You saw this chart, showed this to you last week. It's same critical region of resistance remains in focus. This is the third consecutive week, guys. We've been watching this level right near 290. It's confluence median line for the 50 line of the ascending slope off the lows from 2015. This is a multi-decade channel resistance dating back from the highs that we made in 1994, tagged again in 2007. That level coincides right with the 50 line for the ascending formation right here at 290. So you can see last week we spiked right into that region. If I get a little bit closer look here, we spiked right into that parallel. We closed lower on the week, gapped higher into the open this week, pull back. So guys, this is still critical. Okay, keep your eyes on this, and I really can't stress this enough. A 10-year yield print above 290 would suggest much more that we are under some sort of near-term breakout type of play in yields. Obviously, that would be bearish on the bond price. And should be a pretty big dynamic that market participants will be looking at if we do clear that. So still looking for a possible kickback play off that region. Keep your eye on those as it stands for the DXY. Could see a little bit more upside. 91.33, still bearish in validation. And again, on the intraday charts, no change to any of those levels. Any questions on DXY before we move on? Don't try to fight this just yet. See how the U.S. market's open. If we do get higher, like I said, 90.50 is the next near-term resistance. Weekly opening range comes in just below that. So if you do get a clear above that, you'd be basically looking for that run on 91, 91.33 that we talked about on the weekly charts. Okay. But also keep in mind that if we just look at this a little bit more objectively, guys, like here's the 120-minute chart. You know, as it stands, this could be a 1, 2, extended 3, 4, 5 waves to the downside correction. So you look for a ABC type 1, 2, 3 correction to the upside. Kick back off here, you know, near-term support right back now at former resistance. That takes you back down to 89.75. And again, a topside break, that's sort of an area of exhaustion. Again, you'd start to look for some possible kickback on the index. Eman says, morning, Michael. Welcome back. It's great to be back, Eman. Thanks for that. And again, if I didn't say earlier, happy Valentine's Day for everyone in the room, especially the ladies who are joining us today. Any questions on the DXY before we move off? I wouldn't fight this here, guys, okay? We'll go over the setups that we've been following. Obviously, I just got stopped out on dollar CAD on this last run. I had a quarter of the trade on left from last week. We've been talking about that. Ended up being a wash on the trade as far as the last section of it, but we did have some nice limits taken out on that approach yesterday. I had the rest of the limit down at 125.40. We just couldn't get a clip of that 25.40 level. It got down as low as 25.50 on dollar CAD, but we'll go over that in a moment. So any questions before we move on? That's the DXY and the result of today's CPI print, now testing near-term resistance. That's number one. Here's CAD. Here's what CAD's doing now, and here's what CAD looked like earlier in the week. So I guess we got to go to the previous update here. And here's what dollar CAD looked like to start the week. So again, that Friday spike took us out of the short exposure that we were holding since Wednesday on this spike into 25.90 and then the failure there. So we got into a short, took a little bit off, just a quarter, got stopped out on the rest of that trade on Friday with the release of CAD employment data. It was really weak. You saw that spike higher and pull back again on that spike. Once we cleared back below 26.60, I think it was 26.50 is where I got the entry again. Left it on all weekend long, opened up the week. We got a little bit of drop, took another quarter off, failed to break the highs again on this drop last night. I took off another quarter, so it was only a quarter left on the trade with the stops at break even. And again, obviously, we just broke higher now. Here's what dollar CAD looks like on whole. So first things first, to start off the bat with dollar CAD, where we are in the broader scheme of things. Here's the weekly charts, okay? One of the reasons I was liking to play the pullback here just on a near-term approach was the 100-day moving average. It's been a very clear pivot in price to break to the downside acceleration, break to the upside acceleration, break to the downside acceleration. Here we are failing, okay? But we're not out of the woods yet. I wouldn't say I'm bullish dollar CAD. The big level I'm looking for is still 27.25 on the upside. That's the outside week reversal close that we made here in late December. Okay, and it coincides on a whole bunch of stuff right now. Basic trendline support off 2012, support, break, saw acceleration, breach, acceleration, break, acceleration. Now it's right here again, along with the 50 line for the current downslope. So you have the near-term downslope, you have the longer-term upslope, and you have the outside day reversal close that all lines up at 127.25. So it's still sort of my line in the sand for resistance in dollar CAD. From here, sure, could get a little bit more upside. I wouldn't try to fade it yet, but ultimately, I do want to actually look for some exhaustion here. Here's what dollar CAD looks like on the daily. I guess we could start first. Here's my concern. 2663 is the 618 retracement from the decline off the highs that we made back in December of last year. Okay, it's that whole decline. And we failed to break above it last week. The close today will be important. This is why I'm hesitant or remiss to do anything with dollar CAD until we get closer to the close of the period today. If we pull back again, guys, and close below the 100-day moving average, former swing highs from October of last year, basic trendline resistance or channel resistance off last year's high, if we close back below this region, 126.07, 126, that would be screaming exhaustion. Okay, look at the momentum signature, really struggling to give us a hold or a close here above 60. We haven't done it yet. So if this rally today were to close back below 126 and we would fail to close above 60 in momentum, in my humble opinion, again, that would suggest near-term exhaustion. On the other hand, at that same exact level, guys, if we hold above this, we close above 60 specifically in momentum, again, we could see that run towards 27.50, a little bit higher before things start to really shake out on the short side of this trade. Okay, near term, here's what it looks like. Nothing to do here. As it stands right now, this looks like a compromised break of the weekly opening range. So again, if we open U.S. trade session today and we continue to push higher, 26.60, look for 27.15 for initial topside targets and possible exhaustion points on dollar CAD. But the thing that you do want to pay attention to also, guys, we've been holding a short, right, for days now. And the one thing that I didn't like that on the 120-minute chart, you couldn't see any breaks below 40. Okay, and what do we always say? When markets are in strong downtrends, you want to find resistance near 60, you want to see breaks below 40 and vice versa. So I've been kind of banking on a 40 break, looking for this thing to give me some sort of evidence that momentum is turning over. Here's the 40 hold that we saw yesterday. Again, this means nothing until the 2-hour block closes, but if we do break 60 again, it would suggest that we haven't quite turned over in momentum. So a bit of a frustrating call here in dollar CAD. We've been eking out some gains here and there, but we keep taking break-even stops. So, I don't want to keep being stubborn and trying to press this. We'll see how today's trade session looks like as we get into the U.S. trade session. But near-term targets on the upside, 26.16, 27.15, both areas of interest for possible exhaustion for this rally here today. Questions on Loonie? And again, here's what we look like yesterday on dollar CAD. Or I didn't give you an update on dollar CAD yesterday. This is from Tuesday. So no change to any of those levels. We've simply broken up 2660, 2715, both areas of interest. Okay, next up on tap, that was number 2. Number 3, Kiwi. So Kiwi was one that we've been looking at also since the start of the week, was probably the best play so far that we've been following since the updates on Tuesday. Here's what it looked like, okay, on Tuesday. And the basic premise of the trade was, look, we made a pretty strong defense of that confluence support, basic channel support, in line with the 50 line of the decline right there. The weekly opening range came right into resistance. The 38.2 retracement pulled right back. We had a very clear-cut range to work with. Beautiful, beautiful opening range setup. And guys, these are the ones that you want. Well, first of all, we always want to pick and choose, right? We always want to get what the level is, what the setup is that's going to give us the best bang for our buck. But when you see this kind of price action open the week, the breaks tend to be phenomenal, okay? Because you're coming up against structural confluence resistance. You're within a near-term upslope, so you have that channel, which already has 3 tests now, and you're looking for a basic range break here. Our favored move was for a move higher in Kiwi, just on account of where this thing rebounded off of. Again, if we take a look at Kiwi dollar on the whole, here's what it looks like from the daily chart and even as far as the weekly charts. Okay, the levels that we've been struggling at, 200 week moving average has been support. We've been unable to break below that. Okay, on the daily chart, you look at this thing, you have the 38.2 basic retracement from the advance off the November lows of last year. Okay, and so the rebound that we saw here last week, had a little bit more upside to go in my humble opinion. So when we started off the week, we were looking for the break of this range. Initial targets were 73.06, and the final target of which we just missed yesterday was 73.36 and 73.41. The high that we made was 73.35. So literally like a pip off there before we made an inside candle. And again, here's the breakdown on some further dollar strength based on today's CPI. So now that we've broken the channel, guys, we took out the top 2 targets. We've broken the channel to the downside. Yesterday's levels remain unchanged. Here's what it looked like. This was obviously the Tuesday update. Here's what it looked like last night. Okay, we saw that top side break. We said the focus stays higher while within this channel. Near-term support on a break lower to be 72.45. We're checking that right now. Bullish in validation, 72.30. So even on this drop, okay, if we open US trade and this dribbles down a little bit lower, look for 72.30 for a reaction. 72.29. 618 retracement of the advance off the lows that we made a couple of days back last week, and also former upper median line parallel resistance should be turning support somewhere around that 72.30 level. So look for a reaction there. If we break below that, this thing is straight on bearish, okay? 72.17 would just be a soft target. It's the low day close for the year, but I would expect us to break down much lower near 71.18 again if this level gives out. So for me, focus for dollar Kiwi, or Kiwi dollar rather, as we open to the US trade session, is heading into the 72.45, 72.30 level, looking for some offer of near-term support here. Any questions on Kiwi, where we stand here? So again, yesterday from those levels, we basically ripped, turned right ahead of this. We've taken out channel support, and we're now checking these 2 downside targets. Look for a reaction here for some support, possible re-entries. Remember, guys, basic technical analysis, right? You're in a multi-week, multi-month downtrend, okay? You break the upper parallel, or you break channel resistance, break a resistance, check a support before you move off. Could be a simple technical play. Again, 72.30 is going to be the main area of support on Kiwi. Questions, comments, concerns? All right. Just glancing over at the TV here, seeing that all the indices are turning lower for the session ahead of the US Open. And obviously, a lot of people are going to be taking this and running with it as expectations for Fed consequences. Again, taking a look back at here at the 10-year, guys. I'm going to keep coming back through this throughout the course of the session. And throughout the course of the week, really on that 290 level, 286, we're already well off the lows. If you take this into like a 120-minute charts to get you real close to price action, you can see that we're starting to rebound a little bit. But 290 is the level to watch here on the TNX. Oops. Questions, comments, concerns? Okay. Next up on tap, Amen. Since you're in the room, this one's for you. We opened up this level, or we opened up this setup last week. I know that you were watching it very closely. We got a pretty big bounce off support, and then we were wondering where to go from here. Here's Kiwi N now, and here's how we look like on this earlier in the week. So for Kiwi N, the focus was, look, we were coming into an area of support. I wanted to see a reaction between these two levels. Okay, you had the 38.2 retracement at 79.42. That coincided on the 50 line. Then you had basic slope support. So you had a lower channel here, which had 3 tags, 1, 2, 3. You can count that as a fourth. We dribbled lower last week, but we kind of rebounded and closed right there. So to start the week, that was the level of support I was looking for. That was the level of resistance I was looking for. Couldn't even get a bounce to a 38.2 before we broke lower. So the implications for Kiwi Yen, if you go to the previous update to look at some of the longer term charts, are pretty big here. Okay, this is the confluence region we were looking for on the broader scale. Okay, if we take a look at the weekly charts for Kiwi Yen, we were coming off of consolidation. There was the 52-week moving average. We've now since broken that. And for Kiwi Yen, lots of risk here, amen, for further losses. Okay, the next down target I have isn't until 77.39. 77.22 would complete a 1618 off the high. So for me, this is an objective break of the weekly opening range to the downside. You look for a Thursday, Friday low, 77.39, 77.22, both levels of interest for possible support targets here on Kiwi Yen. Not surprising, right? We saw the yen breakdown, take out support. We saw Kiwi obviously turning around big time today. So, you know, look for these two downside targets if you're holding any shorts on this. Thank you. Well, first of all, Christopher says, good morning. On the TNX, on what level will things get very volatile? 3.5? So, you mean if you break higher? In my humble opinion, 290. Chris, Mr. Whitney, if we break above 290 on a closed basis, that would be invalidating, like I said, a 30-year trend line almost, right? So if that's the case, I don't think that you'd be, you know, outside the realm possibility to look at 304, just the upside targets. This is the high week close. This is the high, the stretch high for last year. Okay, and you know that's just an intermittent target. If we do break here, like I said, there's nothing till 332. Ahead of 350, Chris, I'd be looking at 332. That'd be 100% extension off the low, so 2 equal legs, and that would coincide in the upper parallel pretty much into mid-March, towards the end of March here on the upside if we were to break. But this is big. This is big. Now, one caveat, Chris, on this chart is that this is the weekly chart, right, man? So we have to, you know, the assumption, if you were, that we would get a breakout would actually be a weekly close above 290, not an intraday close. So just keep that in mind as far as TNX is concerned. Chris, does that help? Does that make sense? But on the top side break, man, yeah, things will probably get super volatile if we do close above that. And if we do, 350 is kind of stretched out. Right before that, I'd be looking at 332. It's probably the bigger region where you could see a little bit more kickback. Eman says, thank you. I mean, assume you're talking about Kiwi Yen, right? Played it and profit. Now I am neutral in it right now, like you in Aussie Yen. Cheers. Right. So we'll go over Aussie Yen too. That'll actually be right after the Aussie. Eman, I agree with you on that one. I think it was prudent to put a neutral call on that yesterday, which I did for you guys, just based on what the yen price action was doing and the break of that support in dollar yen. That risk certainly suggests that we could see yen strength continue to resume. So we want to take a very cautious stance there. We'll look at that in a moment. Chris says, thank you. You're more than welcome, Chris. My pleasure. Okay, let's move right along. So Kiwi Yen still looking lower. Let's take a segue real quick into dollar yen, and then we'll look at Aussie and Aussie yen. So here's dollar yen, number 5. This is also one that we highlighted yesterday in the update as we were coming into a near-term support. Again, I thought it was going to hold, guys. I thought that we were coming into a pretty big level. Here's, what am I missing? Here's from last night. Okay, dollar yen. Where are the dollar yen? Here we go. So weekly charts, implications for the break that we were looking at. 107, well, it's covered up here. Let me show you the weekly charts in real life. Here's the weekly charts, right? So 107.83, okay, into 108.13. You had the low swing from April of last year. You had the last year, 2017, low week reversal close. Okay, that gave you 107.83. Both of those levels on the weekly charts coincided with basic trendline support extending off 2012. One touch, two touch, three touch, four touch, five touch. Should have offered something, right? Should have offered something. Major pivot inflection point in price. We either were looking for a rebound or a collapse. And certainly if today closes below this, you're more on the range of collapse. 106.37 is going to be a 618 retracement from the ascent off last year's, 2016 swing low. So big level to keep an eye on. Here's what it looks like on the daily charts. Okay, now the reason that we were looking for some support, that 1618 extension, 107.45 off the high, coincided again with some swing highs from back here in 2016, pretty darn close to those swing lows. And again, that 2016 trendline support also coincides there. Today's close will be paramount. If we close sub 107.50, 107.45, you look for that drop lower, 106.59, 106.38 is going to be your next downside target as far as dollar yen is concerned. Now, a couple things I'll note, guys, on the daily chart. Momentum has been unable to make a new low, okay, in the oscillator. So again, this is just argumentative, but as an observation, if today's close happens and we do close above 30 specifically in momentum, that would be a decent divergent signal into the low. Now, would suggest that maybe we're overdone. All things held constant. If we were to close the market right here, right now, this would remain bearish, sub 107.83. And you'd be looking for a continuation down near 106.37, 106.59. Okay, so dollar yen not giving us the bounce we were looking for. We got to follow the markets. Okay, yen strength continues to be sort of a play. If the market sell-off accelerates, guys, and specifically on the back of good data, this is the exacerbation move that'll tend to push excessive targets even more so past trend. Okay, when you have strong U.S. data, it's going to be seen as bullish for the dollar. It's going to be seen as something that's going to curb or at least hasten the Fed's run to normalize. And that's, bearish for risk, right? Saps money from equity markets. That money will start to filter out from broader risk to relative perceived safety as yields move higher. And this whole dynamic, guys, is a story that we'll come back to time and time again here, as long as markets seem to be in this volatile downswing. So, watch today's close here on dollar yen. It's going to be pretty important. Sub 107.45, I do think you still risk some further losses. Questions? Comments? Concerns? All right, so that is dollar yen. Here's what it looks like on the near term, by the way, and here's what it looked like last night. Okay, so our focus was, look, we had a really nice support bounce here. The initial resistance that we noted was 107.85. Okay, that low day close from 2017. So you basically had a 107.45, 107.85 level of range that we were working with last night. A topside break, you were looking for a reset back near 108.46. And to be quite honest with you, I would have been possibly looking for a new short from up there. Here's what price action did. It rebounded. It held that 2017 low day close. You got an outside 2-hour reversal candle. And here's the drop on CPI, again on the rebound, holding former support, now resistance. All right. Questions on dollar CAD, or dollar yen rather. Moving right along in some of the other dollar crosses that we've been following. Number 6, here's Aussie. Beautiful, clean play. Couldn't have asked for a better move. The thing was coming into resistance last night. Here's what it looked like the previous night. Where's Aussie? Aussie right here. Okay. We opened up the week again, very similar situation with the Kiwi. And as I said on the Sunday or on the Monday update, for me, since I started off the week, guys, I've been really heavily involved in the commodity block. I think the commodity currencies we're looking really, really sharp. So we opened up the week right above or at the 78.13, 78.19 support target that we were looking for on the way down here. Remember, this is where we cut, or at least for me, where I cut short exposure on Aussie. Didn't get that final drop there below, but now that we opened the week there, that was support. So the focus was on either a break above the median line to look for the rebound higher towards the upper parallel, or if we do settle below 78.13, now you're looking to sell rallies back towards a move on 77.40. Well, on Tuesday or Monday, once I wrote this update, a near-term channel had taken shape, and it kept the focus higher again above 78.13. Topside breach above that near-term confluence, and you're looking for a drop here or a rally towards 79.02, 78.93. We turned just pips ahead. Okay, 78.89, 78.90 turned out to be the high. Couldn't get through that. And then the pullback, once we broke channel support, you're now looking lower on the update or on the setup. Not only that, guys, but this reversal in Aussie also takes out what? The objective weekly opening range. Okay, it's Wednesday. So from an objective price point or from an objective price action standpoint, that break should have us looking for a Thursday, Friday low. So on this rebound now from here, look for resistance right back at former support, former weekly opening range lows. That's 78.13, 78.18 is resistance. You're checking the median line here, so you could get a little bit of rebound to the U.S. Open, but essentially on this drop, you're now looking for a move lower towards, whoops, that's not what I meant to do. You're now looking for a move lower towards that 77.44 target, 77.43 target, and that's the key 618 retracement. So very clean price action as far as Aussie dollar is concerned. It's been one of the cleaner setups that we've been following for the last couple of weeks. Okay, so we just ran into resistance, came off. We've broken above this. Remember, bullish invalidation, near-term bullish invalidation was raised to 78.93. Excuse me, it was actually raised to 78.13. And once we broke below that, invalidates the bullish bias. Okay, so even if we rally here, I'd be looking for exhaustion, possible re-entry on the short side. Questions on Aussie? Now, Aussie yen E-man looks like this. It was, I guess, into the start of February trade, probably my best trade so far. And we curbed our appetite once we got this rebound here late last week. This is a trade that obviously we've been following very, very closely. Here's what it looked like at the start of the week. We were following this on the downside all the previous week in the break low. We're looking for that 83 or 80. Well, first of all, we're looking for 84.25, 84.29. That was the level that we rebounded off of. And a break lower from there would likely see accelerated losses towards 83.74 to 83.37. That's exactly what happened, okay? But we didn't get it last week. We got it when the rebound happened. So as we opened up the week, guys, it was rallying towards resistance. And, my idea was, look, you get a little bit kickback from there. But if we come back into the lows for the week, the objective weekly opening range low, okay, that was the 50 line. This should have held. So if we came back into 84.75 and we saw a rebound, that would have kept me bullish, looking for the top side break for a recovery. Okay. Once we broke below that, remember last week the low day close was our bullish invalidation level. So as soon as we cleared 84.95, you're no longer looking for bullish. You're looking to sell rallies. That's exactly what have happened. Once we broke that downside target, this 83.74 target and 83.37 targets that we noted in the report, those have already been taken out. Okay. And the reason I get a lot of questions through email, guys, saying about these comments when I put this, Mike, how do you know that if we break that level, it would be an accelerated loss, right? Well, first of all, I can't take credit for this because this is data driven, right? This obviously happened just now on the or the exacerbation happens on the data release. But the premise of the basis was that on all different time frames, this was a pretty big level. 2017 open, 38.2 retracement. If you take Aussie yen, even from the weekly approach, okay, this is pretty big. 2017 open, basic slope support. This slope that you're looking at in red, is based on these two reference points. 2016 highs, 2017 opening range highs caught a third tag. A parallel extending off last year's low was right there. And not only that, last week, guys, we saw a dip into it, then a rebound, right? Almost 70 pips off the low we closed. So I think there was just cause for us to look for the rebound there. But at the end of the day, if the weekly chart closes sub 84.25, you're really looking for 82, 81.91 would just be a first initial target on the weekly charts. Fast forward into the daily charts, okay, 84, 82.45 would be the 50% retrace. Fast forward into the intraday charts. One other level I have before that is 83.13, okay? This is a long-term 100% extension from the declines off the high. Okay, so boom, boom. This is the 2017 September high. Boom, this is the low that we made in November. Okay, two equal legs gets you 100% extension just lower to 83.13. Okay, near-term resistance and bearish invalidation right back at former support, 84.28, 84.25. I'm not going to work with the 83.74 target anymore. We'll delete that. And these are your new focus levels for dollar, for Aussie yen. As always, I do see a new name in here. If you want to take a snapshot of any of the charts that you see, by the way, guys, camera button at the top of your GoToWebinar screen. You can always take a snapshot if you need an updated chart to keep reference throughout the course of the day. But as far as Aussie yen is concerned, no change to any of the levels that we've been looking at. We've simply failed right here at the median line. We've taken out near-term support, bullish invalidation level. We rebounded off 83.37, and now resistance is right back up here. Beyond this break, again, watch 83.13. I wouldn't wrap up any short exposure if you have it there, but I would be doing something. I'd be taking something off the table. The bigger level is going to be the 84.40, 82.40 level on the downside break if we continue lower from here. But the reason that I put a neutral stance on this yesterday was just because it invalidated the upside approach that we were working with to start the week. And at the end of the day, the weekly opening range was very clear. You made a weekly opening range stretch into resistance. The weekly opening range low crept into support. So like I said yesterday, the focus range was 84.25 into 84.50. This range right here. Once we broke to the downside, you're looking lower below 84.25. Questions on Aussie yen? A good risk barometer, right? A lot of people like to use this as a sort of a tell, if you will, on risk sentiment, just because Aussie, one of the higher yielding currencies, yen, one of the lowest yielding currencies, tend to follow risk markets pretty decently. Okay, and that is Aussie yen. So those are the majors I wanted to cover. Guys, let me know if you have any other questions or trade setups you want to look at. I always, obviously, I want to look at the euro dollar. We went over what the DXY is doing relatively. There's the rally. Well, 90.11 actually held. So again, look for support here into the US Open. But based on what we were looking at with the DXY, here's euro. Okay, here's euro. How do I break this down in ways that make sense to you? I like what price action is doing. I just don't know how to trade it from here. And when I say I don't know how to trade it from here, I don't know how to do it responsibly. I don't know how to put it in a way where I can get a decent stop on this setup to try to put a conviction trade on. But I love what price action is doing. Look, we had failure into the start of the year. The big resistance tag that we missed on the rally late last month was 25.98. That was a longer term 618 retracement from the decline off the 2014 highs. Now the pullback, interestingly enough, found support at an uncanny level. The same longer term median line formation we've been following off the 2015 lows, 50 line, really nice pivot. Here's the start of the year. We broke through the upper median line parallel of this multi-year formation, broke higher. Look where the pullback found support. Right back at that same parallel. Here's the rebound. We turned right out of the monthly open. So what does that mean? For me, this is a very low conviction trade from this juncture. Here's what the intraday chart looks like. All right. So the play, or in my humble opinion, the way that this was the only focus trade that worked out or would have worked out, as a disclaimer, I didn't take anything here, but the break above the upper median line parallel. Okay, that suggests that they should be looking for a rally towards at least former slope support turned resistance. Well, we didn't get quite that high, right? And here's the failure ahead of even just a basic. Well, that was the old 618. Let me get rid of that. Okay, we got a turn. I'm not sure why that got removed. We got a turn right ahead of the basic 618 retracement of the decline. That would have been 2401. But the same respect, look where we found support just right now in this pullback, right at former slope resistance. So break of resistance, check his support, move off, could be the play. I don't know on this, guys, because right now we're sitting mid-range for the week. Rarely would I take a trade based on that. Okay. I want to be either near the close weekly high or the close weekly low. We're basically, right slap in the middle of what the weekly range is doing. So put a gun to my head. I would say preserve this low, look for a rally or a rebound higher. How you effectively trade that from here. Your stop would need to be against that low. So if you're comfortable taking that near-term approach, fine. But even a 40 pip stop for me on the range for euro right now, I think is a little bit too rich for my blood. So we'll have to shelf this one for now. But certainly something we'll be tracking very closely. Okay, questions on euro? Obviously, on the swing side of things, guys, nothing changes. Okay, so our long entry at 23.10 has been triggered. That you're in, and your stop is still going to be wherever we left it. What was it? 22.30, I think, is what we had it last night. So I still like that setup. Intraday, guys who are looking to play this real more near term, look for reaction today here. If we start to dribble lower and that low is preserved into the European close, I'd be interested, or I'd be comfortable in a stop against that low for a near-term stretch higher. Okay. Remember, the target that we are looking at for the swing side of things, guys, is near 2290. 2290 would basically be based on time where this former slope support is, now resistance. So that's sort of the near-term outlook here for euro. Any questions on euro dollar? That is number 8. A couple of other extraneous trade setups, guys. I just want to show you guys real quick, since we had a couple of webinars missing this week. I just want to take a little bit more time, go over some things that we've been following since last week. Real quick, SPX on a daily standpoint. This is the chart that we've been following. Look, nothing changes. SPX, here's what it looks like on the daily charts. We've been looking at this median line formation for some time, and when we started to fall apart early this month, me and Jamie were right on it with the same exact levels that we were looking at. You had the 200-week, okay, or 200-day, excuse me, long-term moving average, and then you had slope support for the lower median line parallel, the formation that we've been sitting in, since 2015. Now, if we take a parallel, just a little drill here. Okay, if we take a parallel of this slope and extend it to the low that we made here on this spike, you still had even a little bit more room before this thing would be like disastrous, right? But to start off the week, and what we've been saying, and what I think we still have to focus on is, look, this is the emphasis here, guys, a close below that slope, below the 200-day moving average. If that materializes, goodbye, sayonara. Okay, a multi-year uptrend is not going to see a quick 2%, 3% further correction, then a reversal. No. So if this breaks below this, we're in big trouble on the asset market side. But the whole thing that we've been talking about since that decline that we made here on the 6th of the month is, look, as long as that low is preserved, man, you can't say this is in a bear market, right? If anything, this is uptrend support. So we have to always try to make sure we're filtering out the noise, guys, and we're staying true to what price action is saying. So the larger picture, people calling for 2,400, 2,350. Okay, fine. That might be the case if we close below this level. But as long as as long as that low is in place, as long as that low is preserved, you're just trading this as a bounce off near-term uptrend support or longer-term uptrend support. Now, Mike, that's all good and dandy from the longer stance, right? Thanks for that. But what do we do from right here? Well, today looks interesting. Why? Well, you're coming off the 50 line right here, if I'm not mistaken. Yes, the 50 line for the current uptrend. That's resistance, where we tagged resistance. And if today closes out at these levels, this will be an outside day reversal off resistance. And specifically, if we close back below the 200-day moving average, which is near 2648, 2650, that again would suggest more near-term downside pressure is at hand. But even that near-term downside pressure, you have to curb any type of expectations past 2580, past that lower parallel. All right, here's the intraday charts. Again, we've been following the anatomy of this breakdown ever since the near-term channel off the yearly open. That broke, turned us bearish. We had another channel that we've been working with from here. That broke, and we even tested it as resistance before continuing lower. So I'm just going to clean up this chart for you now while we're here together. Not the most convincing. Could be a hold, but let's see how it looks. Let's see how it looks into the U.S. Open. Here's new near-term amended targets here for the SPX for those of you who are trading this. Okay, last but not least, the commodities. That was number 9. We're going to do gold and crude real quick to wrap the session here. That's number 10. Here's gold. The only reason I want to talk about it is because obviously, inflation expectations and these types of things do tend to upset gold prices pretty strongly. Here's what gold looks like on the daily chart. So for me, 1316 was the level to watch on a close basis. We couldn't get a close below that last week at all, right? We even dropped as low as like 310 here, 308, 307 on last week's low, and then we closed we closed above that 1316 confluence resistance region. This is a basic 100% extension off the high. So if this is correctionary and ABC type play, it's also a basic 38-2 retracement off the September lows, off the December lows rather. Just below that, you have the median line for the current operative formation that we're following. So we were looking for a support bounce early in the week. We got that support bounce. But what we do from here is, I think, from my mind, a little trickier. Here's what it looks like on the intraday chart. You got a big old doji so far to start off the session today. But here's the formation that we were looking at. So really nasty channel. The upper channel held really nice as channel resistance, but the lower channel kind of messy. So when we started off the week, we said, look for a reaction near 1330. That's going to be the line in the sand for me. If we break 1330, look for a rally 1336. Look for the upper parallel. High day close comes in at 1346. So we pulled higher. Here's the CPI print, obviously a dollar ripperoo, but we still have not made a close below former channel resistance. Again, bring it into a line chart. Forget all the wicks and the messiness. So, I'm really interested, and again, I hate to be more reluctant to give you guys things to look at that you can't actually or shouldn't actually trade yet, but for me, this is going to be a tell. This is going to be a tell. If gold closes sub 1327 on a daily close basis today, you get a marker close on this line chart below that region, I do think you're at risk for a bigger setback, okay? A larger rally in the dollar, bigger setback in gold. All things held constant, we broke resistance Forget the wick that was data driven. We've now checked former channel support, former channel resistance as support, and the necessity is for us to break through the pre-CPI high. Once we do that, I do think you're at a decent play there for further strength in gold prices. But the big picture in gold, we're still in the uptrend. I don't care what anyone says. There's a lot of people have different opinions on gold. Here's gold on the weekly chart. We've been following this ascending trend formation since the 2016 low that we made. And yeah, on this correction, I wouldn't be surprised to see 1285, 1302, but these are really our bullish invalidation levels. We don't want to see price drop beyond that. So picture is pretty clean here. I want to see how today's market looks on the close. If we do preserve that former channel resistance, now turn support, look for a push higher through 1336. Last but not least, crude, number 11. This is another one that we've been following very closely. Now, the breakdown took down all the targets that we were looking at. The final target I think I had for you guys was 59. That was the swing high that we made in November for the November opening range, or the November high, that is, altogether. And that was the level of which we closed right above last week, right? So 59, we're pushing back below. Downside targets beyond here, if we continue to move, guys, you have the 100-day moving average. That comes in right around 57.67, but the 38.2 retracement of the entire advance from last year's low comes in at 57.22. Okay, so let me just add that 100-day moving average, 57.67. 100-day moving average, all right? So for crude prices on the intraday, here's what it looks like. I just want to see if we adjust this slope to the new high, if that encompasses price action here. Could. Okay, could. I don't like that we broke through the lower parallel here, but look, we're returning again, right, basically at the median line. So let's do this. New downside, obviously the support conflicts we've been talking about, the 100-day moving average converges on the lower parallel near 57.68, but 59.30, near-term resistance, median line, former swing lows. Downside move. I think this stretch comfortably gets into 57.68, 57.22. So just keep that in mind here on the crude trade. All right, and that's pretty much all I had, guys. It's great to be back. To see you all again. We'll be back on tomorrow morning as normal. Jamie will be on a little later today with the midweek strategy webinar. Definitely look forward to, or I definitely encourage you guys to attend that to get a little bit broader picture of what we're looking at from the swing side of things. Eman says, happy Valentine's Day to you and all around you. Thanks, pal, says Kelly. Hey, thanks to all of you guys as well. For those of you celebrating, I hope you have an awesome and lovable Valentine's Day. It's a great week, guys. Lots of stuff going on. So hopefully we got a lot more volatility on hand as we get deeper into the week. See you guys all tomorrow. Again, Jamie will be up in just a little bit. Best of luck trading, guys. Cheers.